koutou katoa. Humanity risks an uninsurable future as the frequency and severity of extreme weather and other climate-related disasters increase. The damaging effects on our towns, cities, and public infrastructure will escalate. Sea level rise, in particular, will be a game changer, with immense impacts on coastal communities. And as the tide of climate-related disaster engulfs more places, the cost of property insurance, whether for homes or businesses or community facilities, will rise. In higher risk locations, insurance retreat will accelerate. More properties will become uninsurable. Inevitably, such developments will affect the value of property and other assets, but the wider impacts could be far more profound. Reflecting on the potential global risks, Gunther Thallinger, a member of the board of management of Allianz SE, the world's largest insurance company, offered the following stark warning in March last year. He said, "Extreme weather phenomena drive physical risks to all categories of human-owned assets: land, houses, roads, power lines, railways, ports, and factories. Heat and water destroy capital. Flooded homes lose value. Overheated cities become uninhabitable. Entire asset classes are degrading in real time, which translates into a loss of value, business interruption, and market devaluation on a systemic level, as we witness." In short, climate change threatens not merely a loss of insurance cover, it also threatens the foundations of the global financial system, with the risk of a large-scale climate-induced credit crunch. Yet without a stable and viable financial system, civilization as we know it will become impossible. Leading insurers are not alone in their concerns. In 2024, a report by the Budget Committee of the United States Senate offered the following sober warning, to quote, "As climate change gets worse, so does trouble in insurance markets, threatening mortgage markets and property values. The United States could be looking at a systemic shock to the economy similar to the financial crisis of 2008, if not greater." Across the world, overall costs of weather-related events have been growing. This includes not only greater losses of insured properties, but also higher economic, fiscal, and social costs. Significantly, according to Swiss Re, a major reinsurer, the relative loss burden from natural disasters compared to GDP has doubled since the 1990s. In other words, inflation-adjusted insured losses globally have been growing twice as fast as the rate of global GDP. Ultimately, this trend is unsustainable. In most countries, including Aotearoa, flooding remains the main cause of weather-related property damage. But severe droughts are also contributing to more damage. As the land in towns and cities dries out, it often compacts, causing subsidence and damage to building foundations. Many parts of Auckland are vulnerable to this phenomenon. Droughts also contribute to more intense fires. The unprecedented fires in Los Angeles in January last year highlight that even the wealthiest citizens in high-income countries are vulnerable to wildfires. Inevitably, given current trends, property insurance will become progressively more costly globally and thus less affordable. Already spiralling insurance costs for homes, businesses, and public facilities are affecting living costs, contributing to higher prices for goods and services such as rents and local rates. Sadly, this disproportionately affects poorer households, exacerbating social inequities. Moreover, as property insurance becomes less affordable and in many cases less accessible, resilience to natural hazard events like earthquakes, storms and wildfires will decline. Less resilience will exacerbate the cost of disasters. Recovery will take longer. Material hardship and inequality will worsen, undermining social cohesion. Governing will become harder, threatening democratic stability. These grim projections are not inevitable. An uninsurable future is not preordained. Countries like Aotearoa have choices. Collectively, we can pursue a more resilient future or a less resilient one. Currently, we are choosing less resilience. That can and must change. In this context, property insurance matters. It plays a critical stabilising role in our economy and society, even more so in a climate-impacted future. Specifically, insurance acts as a shock absorber, spreading the financial impact of damage and loss across the wider community and the international financial community. It also provides anticipatory financing, making capital for recovery available more rapidly after damaging events. For property owners, and I suspect that includes many in this room, insurance offers a sense of security and reduces financial vulnerability if homes or businesses sustain significant damage. And for people wanting to buy their own home, insurance is often essential. No insurance, no mortgage. No mortgage, no home. In a climate-impacted world, however, those with mortgages face a new, harsh and unwelcome reality. If insurers withdraw their cover because of rising natural hazard risks, lenders will ultimately demand repayment of the mortgage. Yet uninsurable properties have little value. Affected homeowners will thus face property purgatory, with homes they cannot sell, debts they cannot repay, and no resources to relocate. Even worse, uninsurable homes can be risky places to live. Adding to the uncertainty, insurers can choose not to renew an annual contract with little warning. And around the world, property purgatory is increasing. Renters too are impacted negatively. They face higher rents, less secure rentals, and more frequent moves. Also, many renters, and this is particularly the case here in New Zealand, lack contents insurance. It is simply too expensive. Hence, when disasters strike, everything they own can be lost. And many of you will know of that in various parts of New Zealand over recent years. Here in Aotearoa, between 2000 and 2025, average home insurance premiums rose over 900%. That is ninefold, or over fourfold in real terms. While not the only factor, insurance losses from major natural disasters, including severe weather events, were a significant driver of rising premiums. Private insurers are also pricing risk now more accurately. One local insurer, Tower, now sets its premiums to reflect 4 types of risk: earthquakes, landslides, flooding, and storm surge. The more risks a property faces and the greater those risks, the higher the premium. Insurers are also reducing their exposure to higher risk areas by not taking on new customers in those locations. Unfortunately, the extent of insurance retreat in this country is unknown. We simply lack publicly available data. That needs to change. But almost certainly, home insurance penetration rates are falling while underinsurance is increasing. As Professor Renwick's presentation highlighted earlier this morning, our current climate trajectory means that with absolute certainty, we face more storms, more severe rainfall events, and more landslides. Already, severe weather events here in Aotearoa have been increasing from around one a month to almost one every week recently. Red warnings and states of emergency are becoming common. Places that have never previously experienced flooding are being affected, often with little warning. Here are a few images from the 20th of April this year in my street and a neighbouring street in south central Wellington. This is Wright Street, in which 5 houses suffered water damage and 11 cars were written off. But in some other streets, the damage was even more extensive. And of course, in some parts of the country, major damaging floods have occurred repeatedly over recent years. This is Westport 5 years ago. Sea level rise, currently about 4 centimetres per decade, is accelerating. Already tens of thousands of homes face a high risk of flooding. Inevitably, more coastal communities will face coastal erosion, elevated water tables, increasing subsidence, higher storm surges, and tidal flooding. Exacerbating the problem here in Aotearoa is inadequate governance and regulation. Local councils have been reluctant to stop residential or other developments in higher risk locations. Also, there has been no guaranteed government funding to assist councils with the relocation of at-risk communities, despite a lot of advice that they should provide such funding. How then should we proceed? One option is a market-led approach. This relies on the pricing of risk to drive societal change. Property markets are left to adjust to rising climate-related risks. Proactive planned relocation and publicly funded property buyouts are largely rejected. Instead, households without the means to relocate will be left to face multiple perils on their own. Inevitably, this approach means lower overall insurance cover, more underinsurance, fewer precautionary measures, worse property damage, greater suffering, hardship, and greater inequality. Economic and societal resilience will decline, and long-term economic and fiscal costs will rise. But there is another way. As argued in my recent book, Insuring the Future, we can reject a wholly market-led approach. Instead, we can adopt a solidaristic or social model, one that embraces community responsibility, collective risk pooling, and compensatory justice. Fortunately, we have already a sound basis for this model. The Natural Hazards Commission, formerly Earthquake Commission or EQC, was established in the 1940s to provide cover for earthquakes and other major geophysical risks when it became clear that the private sector would not offer adequate cover. Like similar entities around the world, the Commission pools risks by charging all homeowners a levy when they purchase dwelling insurance. This has contributed, at least until recently, to a high rate of dwelling insurance in this country. And that has proved vital following catastrophic events like the Canterbury earthquakes. A solidaristic model recognises the state's unique role in risk management, serving as the insurer of last resort and assisting households and communities when facing risks beyond their capacity to control or manage. It understands that given the unprecedented risks of climate change, only the state can protect the long-term public interest. Pursuing a solidaristic model will require significant reforms. The mandate of the Natural Hazards Commission, in my view, must be extended to embrace weather-related perils, not least flooding, and the provision of temporary insurance cover in the context of insurance retreat and planned relocation. It must also be conferred a major adaptation role, thus internalising the incentives for long-term risk avoidance and risk reduction. Additionally, we need a reform system of means-tested home insurance subsidies and proper measuring and monitoring of insurance affordability. And look out for the report eventually of a government body that's looking at this whole issue of insurance affordability. Finally, where protecting properties is impracticable and or too costly, communities at risk of flooding, including coastal inundation, must be moved out of harm's way proactively and with capped, targeted public compensation, especially for those losing their only home. In summary, the escalating impacts of the climate crisis on public and private property, insurance premiums, the wider economy, and indeed the entire social fabric are becoming undeniable. A largely market-led model, which it seems this government prefers, will worsen these economic and societal impacts. Instead, we need a solidaristic approach, one that exercises proper foresight, avoids and mitigates risk, and shares the cost of residual risk across the wider community, thereby enabling a fairer and more secure future. Ultimately, however, an insurable future will require urgent and effective policy measures globally and locally to mitigate climate change. As Professor Renwick emphasised this morning, 3 degrees of warming would be catastrophic, exceeding the adaptive capacity of even the best solidaristic insurance model. We must avoid such an outcome. Thank you.